This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning a couple noted market experts and well-recognized financial writers. No stranger to our regular listeners is Ty Andros, the president of TraderView, publisher of the TEDbits website, and applied Austrian economist and paper fixer, right, Ty?
Yeah, I'm an applied Austrian economist, and I repair currency.
Also, we have a special guest here this morning, Catherine Austin Fitz. She's publisher of the Solari report. Welcome, Catherine.
Gordon, it is a real pleasure to join you today.
Catherine, I wonder if you could familiarize our listeners with your background, the things you're working on, and specifically the Solari report.
Okay, I spent many years on Wall Street. I was a partner and member of the board of Dillon Read and Company, and then joined the Bush administration and served as Assistant Secretary of Housing, Federal Housing Commissioner. And then started an investment bank in Washington, the Hamilton Securities Group, which was also a financial software developer. And I was very interested in the intersection of the financial markets with the economics of place. And then, have you ever seen the movie Enemy of the State?
Yes, I have.
Gene Hackman. Well, I played Will Smith in real life and had a chance, the opportunity to litigate with the federal government for 11 years and learned a great deal about the covert economy through that. And as a result, ended up speaking widely publicly about money and financial literacy, and had a lot of people ask me to help them with their investments. And on about the 1,000th time, I said, I'm not an investment advisor. You know, the bell went off in my head and I said, oh, I guess I've become an investment advisor. So I started Solari Investment Advisory Services, and then later with a partner started Ceiling Advisor. We manage money, and then because I was getting so many questions, we decided to do a subscription service, the Solari Report. We blog at Solari.com, and then once a week I do a private, essentially radio show for people about what's going on in the markets and issues are related to personal wealth, but how you protect your personal wealth in the world as it really is, not in the way that the major media, pretends it is. So that's me. It's Solari, the Solari Report once a week, and you can find out more at our blog, Solari.com.
It's amazing how careers develop and what you start doing and where it ends up, isn't it?
The market always leads us in a good direction.
Doesn't it? I started my career and spent most of it in technology.
Really? I didn't. No wonder your charts are so wonderful.
It's the old engineer in me. What can I say?
My partner, it's funny. All my partners are engineers, and I love engineers. So now I know why I love your commentaries.
Thank you very much. I appreciate it. Catherine, one of the reasons many reasons, but one of them that I asked you to join Ty and I here this morning, because you'd had an interview with one of our regular co-hosts, John Rubino, and you made some absolutely fascinating observations and comments in that interview that I'd like you to share with our listeners here this morning. And the question actually that I have to lead it is, when does the current unsustainable and lopsided business model of this precious metals market finally blow up and default? I mean, clearly, and we've had a number of tapes recently here on gold and what was involved in the smash on April the 12th, so I won't bore a lot of our listeners with that, but it really comes down to how long can it be sustained. So I'll open it up to you with that question.
Well, it depends on what exactly you mean by that, but in theory, forever. In other words, if you look at a lot of the market commentary that we see, including in the gold market, you're looking at a paradigm that we had before taking into account the impact of new technology and the impact of globalization. I have a scenario I call the slow burn, which essentially says that centralized management can manage things much longer and further, than people think. And so, I keep hearing people say, when will fundamental market economics reassert themselves? Well, the paradigm is changing, and a lot of the assumptions behind the markets that we understood over the last 50 years are just no longer operative. So I'm a believer that centralization and management of the economy can last longer than people generally think. Now, let me just dive down into the gold market. I said in the commentary with John that we're watching two dynamics. One is management. So sort of central bankers managing the financial system and managing it for a variety of strategic goals that, in the short run can take us very far from what you and Ty and I would think of as market economics. But what we also have is we have fundamentals. And I think both of those long-term point to a rising and a stronger gold price. So I continue to believe that we're in a primary trend up for gold, but I think it's a managed one. And I think, we sit here and we guess about what the short-term management issues are. But one of the short-term management issues has been this year is how do we keep the trillions of dollars being printed in the bond market? And if I had to guess, I would say that we were watching a financial system that was trying to achieve two things. One is keeping money in the bond market, and of course, creating volatility in risk-adjusted assets, particularly precious metals, will certainly help you do that. The other is we're watching a financial system getting ready to take down and resolve big banks without the too big to fail policy, which means a lot of institutions need to cover their shorts, including their shorts in gold. So to me, what we watched in April was a managed move. It was very painful and ugly after the long consolidation we've had since 2011. But, it was a managed move, and painful as it is, at some point, the fundamentals should bring us out.
You mentioned the volatility, which really scares people with gold, no question, a risk that goes with it. But also some of this new protection of too big to fail. The Bank of England and Fed recently published an overview of it, and we're going to actually allow some of the derivatives in it to be used effectively, if I can use that word. Could you expand on that?
Well, Dodd-Frank, which passed after the bailouts in 2008, so I believe it passed in 2010, required the regulators to create a process of resolution that didn't require too big to fail. What that means, of course, is that the creditors and the uninsured depositors are going to either get written down or get swapped into an equity interest. There are many possibilities of how these things could go down. And of course, that sets the possibility of contagion everywhere. Now, my understanding, I'm not a bankruptcy expert, but the bankruptcy laws were changed in 2005. And between that and a practical matter, what we're going to see in these situations is the derivative positions, because of the desire not to set off contagion, are going to get, they're going to get essentially seniority treatment from the regulators.
Yeah, can you expound on that a little bit, please?
If you're, so we remember Paulson running around with his, like a chicken with his head cut off during 2008, 2009. When you're going to resolve a big bank, what are the positions in that big bank that are going to most create contagion throughout the financial system? And of course, the big ones are going to be, you're going to worry about liquidity and deposits globally. You're going to worry about the money market accounts, which is why I'm assuming that the SEC is promulgating new regulations on the money markets. But finally, you're going to worry about the swap positions, and the derivative positions, especially because such a big piece of it are the interest rate swaps that have been used to bring down interest rates. And so what are the regulators are going to make sure doesn't turn into contagion? I'm assuming it's going to be derivatives, and that's why the bankruptcy rules were changed in 2005. I'm not a legal expert on bankruptcy, so I don't know the details of it. Just my understanding is it's going to make it easier for them to do that.
It's certainly not getting a lot of visibility in the media, is it? Even the non-mainstream media.
Gordon, I don't know if you've ever tried to have a, I did one show on the Solari Report, sort of Derivatives 101, and the least turnout I've ever gotten on the Solari report. It's for somebody who's not people with your background or Ty's background, it's a deadly subject.
I found that out too. I wrote in 2000 a series called The Sultans of Swap, where I actually got right into this $600 trillion.
I remember that. It was fabulous.
Well, thank you. Thank you very much. But I can tell you, most people's eyes just glazed over when I got into the subject. But to me, it is absolutely central to understanding really what's at play here globally, in addition to the $71 trillion shadow banking system on a global basis. And between putting the two together really allows you to understand some of the elements of what's going on in the gold market.
Well, it's a little bit scarier than that. I was on the board of Sallie Mae in the 90s, and Sallie Mae consists of a third of the board members are vice chairmen of major banks. And we had, I think there was seven or eight really capable, intelligent vice chairmen from some pretty big banks. And Sallie Mae at the time was doing gangbusters in terms of doing, starting, they were an early derivatives player. And at one point, the financial operation brought in the young guy who was the derivatives and gave a presentation to all of us. And what I realized is none of us, including the vice chairman of the 7 banks, really understood what in the world was going on and how this all worked. So it's an example of complexity that's gone way ahead of most people. And of course, given tremendous advantage to the people who've taken the time to master it.
I think this is a really key point. We've got a globalized system, and it's not robust. It's very, very fragile. And these are just not flippant words. And so it's never been stress tested. Here's my old engineering coming in. So what happens, we have senior management. I think we just found out with JP Morgan, did we not, that do not have a sound grasp, maybe conceptually, but even the mechanics and the operations of these complexities and how fast it's happening. And it's almost like an accident waiting to happen. Do you feel like that, Catherine?
No, and I'll tell you why. Not to say that those situations don't happen. I feel that it has given, if you look at who governs the financial system, and, I would call the central bankers the implementers, it has given them a way to basically lock in the future. In other words, you use sovereign credit. And frankly, if you look at you have a very consolidated positions in the derivative market. So if you look in the United States, it's a few very big banks. And my guess is they're not trading on their own account. They're trading on the account of the Exchange Stabilization Fund in the U.S. Treasury. So it's basically sovereign credit that's behind it. And it's part of what's, gives the central bankers and the sovereign government so much power to kind of engineer and manage the markets. But if you look at what their sort of their dictum under national security law is, it gives them the ability to go out and dictate what the future will be. And then everybody's got to go along with it, because if they don't, it'll crash the global financial system. So I literally think you've given central planners the power to basically orchestrate a framework into the future and use derivatives to do it.
Ty, you had a question?
Actually, I wanted to comment, I am in the derivatives industry. And I believe, there's over-the-counter derivatives and there's exchange traded. And one of them are the most unstable parts of I'll call it the house of cards. And the other ones, I believe, are have the most market integrity. And, when you look at the global banks, that's all marginless trading. And they're only as good as your counterparty. And,
right.
And most of the counterparties have put up no kind of deposits. They're just trading on their credit rating. Whereas if you're an exchange traded derivative, your counterparties are good every minute of every day because it's managed by the clearing association. And, it's the daisy chain of why they can't let those markets collapse. And of course, it's a big cash cow too, because when you do those over-the-counter derivatives, there is no marketplace. The only person making the market is your counterparty, and he's got you caught between a rock and a hard place. So the bid and the ask on those derivative contracts is a mile wide.
Right.
And the people that have to pay it are the people that are on the other side of it, the hedgers that trust in J.P. Morgan and the big banks. And but I do believe it is completely for manipulative purposes and managing the market. When you talked a little earlier about too big to fail, I guess I'd like to comment there that I viewed Dodd-Frank not as a resolution document, but actually as a document to prevent resolution. Even though it was labeled one as bringing safety, to me it was one enshrining too big to fail, and we're going to make sure that we're putting in stuff into Dodd-Frank to consolidate the industry in the what we'll call it the biggest hands. I don't know if I would call the strongest hands, and and that this was quite a big element of the Depression in the 1930s, where the small banks were taken down and absorbed by the big banks. And of course, Catherine, I'm sure you're fully aware of how much more of the assets the big players have now than even 10 or 15 years ago. They've exploded in size. And so Dodd-Frank to me was just I'm a black helicopter guy. I believe that there are people out there that own and run the world, and they own and run the banks, and it's the same people that own and run the banks that own the Fed, and they own all the productive assets in the world if it's really done right. I saw some in your comments about that study in Switzerland, and I have seen that, but I've also seen other studies like that. And that it's a very small group of people that actually own and run the world, and I, to me, it's the group that started it all, the Rothschilds, over 4 centuries ago, and they've been playing this boom and bust game with fiat currencies for centuries, and they've used that inflation and deflation and the ability to manufacture money to actually gather the real wealth, which to me is Austrian. And real wealth is the same thing as what Buffett says. It's a real functioning business that creates cash flow. And so I look at it in a much more sinister way than maybe you do, Catherine. I really don't believe the Dodd-Frank or the Affordable Care Act was done in anything other than to consolidate power and direct demand to the biggest players who are owned by the biggest players.
Well, Ty, I would agree with everything you just said. And here's how I would say it. My most popular blog post is one called Financial Coup d'etat. I think a bubble or a series of bubbles was engineered during the 90s and the early 2000s that would allow, and the person, I described the group that you just described as Mr. Global. That's my nickname. So I think Mr. Global engineered a couple of bubbles that would allow them to pull out a lot of capital out of the North America and Europe before the baby boomers started asking for their money back. And, those funds have been shifted in a variety of mechanisms. A lot of what the financial coup d'etat was done with was financial fraud. They crashed the markets in 2008 and basically got the taxpayers to clean up all their financial, the fraudulent paper they issued. And in the process of the two events, I estimate they gave approximately 40 trillion, the markets and the taxpayers about $40 trillion to Mr. Global. And so to me, Dodd-Frank is simply a document to be turned over to the bureaucrats to say, okay, now that the financial coup d'etat is over and we've stolen $40 trillion, how do we manage the next phase? So in that sense, I agree with you completely.
Well, to me, the bubbles are actually bigger than ever. And the next bust is going to be equally as great. And this is actually what I call the Cambodian killing fields, and where they transfer all the assets, they cash out at the top, transfer the ownership to the public, who's left holding an empty bag. And then as the leverage fails, they come back in and buy those things at a discount and leave the detritus behind. To me, we're in I have read your article, and I do believe that they are doing what I'll call a managed retreat in gold. and but that they've got to let gold up because to re-reserve the system,
Right.
they have got to make a dwarf of the current amount of credit that's out there. And that there's, a date with devaluation that may be 1,000%. And at that point, then actually the system can be reserved quite easily. But at that point, we're not even close to there. And, fiat currency to me is the devil's spawn.
Well, here's what I'm trying to figure out, and you guys could help me do that. If you look at, so if you look at the bond market for the last 30 to 50 years, what we've been doing is printing money. And now, they've got an enormous amount of money in the bond market, thanks to, I think, in no small part to the derivatives. They've been able to bring interest rates down. And part of that is globalization and sort of the devaluation of labor. But you now have trillions of dollars sitting in the bond market. How do you keep it in there? It's not earning very much. How do you keep it in there without, driving interest rates back up? And so one of my questions is, are we coming into an effort to literally engineer what I call a planetary debt for equity swap, where they print an almost equivalent amount of money and pump it into the equity markets, basically to dilute what's going on in the bond market? If we look for the last couple of months, we see central bankers buying equities in record amounts. I just had one of my clients get off the phone with Switzerland, and the Swiss bank just bought 85 billion of equities over the last month, apparently.
Yeah, I was just going to insert in that exactly. I would believe that's already in process. I'm seeing more and more central banks now accepting equities. I'm pulling them onto the balance sheet. I see it as starting to accelerate, and though without any real major announcements, but that's what's already beginning to happen. And I think you'll see, and in Japan specifically, it looks like they're getting a lot more aggressive.
Yeah, but understand, equities is, it's a form of the indirect exchange. I mean, it's a real asset. It's like gold. Okay, maybe overvalued, but it's real.
Right.
I mean, they really understand they're holding worthless paper, and how in the heck do you get out? And so when you're printing as much money as they are, which is, a staggering amount, I just did the math, and it's, they're doing, just to read it off because it's so stunning. They're printing, and this is just the Bank of Japan and United States. They're printing $59,000 a second, 3.58 million per minute, 215 million per hour, 5.1 billion per day, 160,000 million per month, and right now they're going to, print 2 million just in the next year. And I quoted in those terms because, a billion and a trillion is a concept that I don't believe a human can understand.
The long-term banking, cycle always ends with the swap of transferring paper or debt for equity or real value.
They're exchanging those IOUs on their balance sheet for equity.
Exactly. For our listeners that aren't schooled in Austrian, it's referred to as the indirect exchange. But every time you go through these boom and bust cycles that we're so familiar with, and they're typically quite in the Condrati series of 50 to 60 years, the downside of it is all of this is moved into real assets, all of this debt and false paper, whether those real assets are gold, silver, real estate, but they're tangible, and whether they're secured because bad debt and they seize the collateral. And so right now, Catherine, as you're well aware, there's a real shortage of good collateral out there. And and that's the problem. And we're seeing the collateral actually collapse. And one of the things that I'm seeing is real equity growth is not happening. If you look at the statistics of total equities, I know there's a large numbers of buybacks, but if you start to get into how you evaluate companies of enterprise value, et cetera, get into the metrics of it, they have shrinking EBITDAs right now, which is the basics for looking at a true valuation on an enterprise. I mean, they have lots of cash, but it's cash that now they're getting out of debt, but we're getting good cash flows. But now the cash flows are just barely positive. I don't know if you've noticed that, which reflects in equities, which reflects in collateral values.
Right. Well, the big question for this year has been, how are they going to keep the earnings? I mean, if you look at where a lot of the earnings has been coming from, it's been coming from, using the drops in interest rates to sort of manipulate the balance sheet, using technology or globalization to lower the cost of labor, and buying back in shares. It's, all that kind of stuff. And the question is, okay, well, where are real earnings going to come from, particularly if the customers ultimately in the economy, whether it's direct or indirect, just don't have jobs. I mean, at what point can you levitate corporate earnings with government contracts without real consumers? Is part of what we're watching.
Well, as we both know, the corporate profits against any GDPs are nosebleed kinds of levels at the sacrifice of the labor that's been squeezed, and we see that in disposable, which is going to certainly impact supply. But what this pursuit of RONA, return on net assets, that the corporations are driving means that they're chasing not just bottom line, but non-operating investments. So they're not investing, well, I'll use the word organic, they're not investing in the top line and have stopped that. You see it, the CapEx, capital expenditures have been plummeting right now. And you can go through it, there's no investment.
Well, but Gordon, let me look at this from Mr. Global standpoint. Because I'm with Ty, I'm a member of the Black Helicopter Club. If you go in and you look at different American corporations right now, as their stock prices rise, what are they doing? They're acquiring companies all over the world. If you're the United States and you want to improve your position globally, you run your stock market up, and then you have all your companies buy up everybody in the emerging markets, which for the most part have been generally consolidating. So there's been and part of that's the drop in commodities, but you have this divergence between commodities and with it a lot of the emerging markets. High stock prices in the United States means we have an acquisition party to buy up lots of stuff cheap.
I agree with you completely. That is the game, because you're using your stock price to take over.
Or your worthless hoard of dollars.
So what you do is you load up on debt off balance sheet. You keep and you drive up your stock because you can really reflect it on earnings because you're not investing in the top line, and you can take over those who've taken the risk. You don't even have to take risks to get real organic growth. It's kind of a subtle game, but it's not subtle. And now it's running to the point where it's almost epidemic.
And you exchange a worthless asset for...
Well, that's the bottom line, exactly as Ty says. You're exchanging debt, which is useless paper, for something that's real and is going to give you a sustaining discounted free cash flow, which is true value and true wealth.
Right, but you're describing something that let's get back to the problem. The model we're dealing with is crime pays. If I can take my printer and print off worthless paper and use it to buy up tangible assets all around the world, that has an infinite rate of return. That's a phenomenal.
Exactly. And people talk about central bank balance sheets. I would argue that a central bank can't lose money because they printed it out of thin air.
Right. I agree with you.
I mean, the idea that they're going to run out of money. People say that it's all for, stimulating the economy. To me, QE is about supporting the insolvencies. It has nothing to do.
Well, I would say it's about re-engineering the economy. In other words, what I think we're looking at is a fundamental re-engineering of the governance system on planet Earth, and who owns what, and how things are managed. And in the process, your three big long-term trends are going on. One is there's been a decision to essentially put corporations in charge of governing assets instead of governments. And so we're watching assets being moved to corporations at low price and liabilities being shifted back essentially for free. That's number one. Number two, we're watching a rebalancing of the global economy. And so the middle classes are being squeezed and diminished in the developed world, but they're growing up in the emerging markets. And so labor is being rebalanced, but in a way that fundamentally shapes the relationship between labor and capital. And then finally, we're seeing new technology that's coming out of the laboratories. And I don't think we've even begun to envision or understand the extent to which it's going to have an unbelievable effect over the next 10 to 20 years, but whether it's robotics or new fabrication technology or what can, we've just seen literally in the last month, announcements because of what the Chinese have been doing with the solar panels and bringing down the manufacturing cost, that we're literally at a tipping point where now, we can begin to implement over the next couple of years solar that really is competitive economically with coal. And that's a very big new thing. So, I think we have these three things going on in combination that are going to absolutely rock our world. And unfortunately, give Mr. Global the ability to get away with a lot of this stuff. And that's why I think it's so important what each one of you are doing, what we're all doing, which is, what the average person needs is a map of what the game is. And, we've literally seen since 1989 an integration of economic warfare with political warfare. And a lot of the market, price management is to try and manage those prices in a way that gives the Mr. Global and the Anglo-American alliance, the strategic advantages they need to win globally. And it produces some pretty Orwellian effects, but it does continue to levitate the dollar, despite the fact that the dollar on any fundamental economic basis should be worthless.
These central banks, their balance sheets are exploding. There's no limit increase it because they're basically can't be insolvent. I've noticed that gold has been tracking extremely close to the cumulative increase in the balance sheets of the big seven central banks, to the tune that it's about $210 per ounce per $1 trillion of expansion, and it's an incredible R-squared fit. Have you noticed that sort of thing?
Yeah, I've seen. I don't know if I've seen your charts, but I've seen charts that show the same thing.
It goes back to the very first point that you came up with. It's a very managed process, centralized, that's got all the earmarks of control. And what it means is, in the gold we started this conversation on, it says there's going to be continuous shakeouts from the weak hands to the strong hands, but that price of gold, these balance sheets are easily going to double. From 15 trillion to 30 trillion, but certainly north of 25 trillion in the next 12 to 18 months, in my mind, which is a pretty good way of extrapolating what gold price may be. Okay. Does that pass your common sense test?
I absolutely believe that Mr. Global wants a managed rise in the price of gold. Now, if you look at how much gold's run up over the last, over the last 10 to 12 years, and the extent to which it's just trounced equities, I think, and I keep talking about the planetary debt for equity swap. I think Mr. Global very much needs the equity bucket to fill up right now. And so, if anything, we've seen equities race way ahead of gold and gold smash down. And I think that the thing I'd love to know is what's the trajectory going forward. But I think there's going to be a real effort to bubble equities in a very significant way. And the other big question we need to ask and answer is, as Ty said, is this just a chance for the insiders to get their money out? Or are they really up to, pouring enough money into the equity markets to offset the money they've poured into the bond markets?
I would say that the insiders are grabbing the gold, especially the smartest ones, and that they've got to let gold up very quickly, because obviously there's been runs going on the bullion banks, and they've got to get the price higher enough to get some dishoarding, to get some stuff back into inventories, to get people to sell. And they can't sit here. To me, what happened in April has become an exploding cigar. And they wanted to discourage people from running into real money. But that's now backfired, and it's continuing to backfire. The numbers coming out of China are just stunning. And they've got to, and India and Turkey and all through the Middle East, those people haven't been fooled. And of course, they haven't been fooled because they've gone through hyperinflation a number of times over the centuries.
Right.
And so we're really, the U.S. citizen that's, in the, I'll call it the headlights of the mainstream media and the mainstream financial industry, they can be run around like, deer in the headlights. But that the other people who really have actually memory of hyperinflation and everything else. And I'm a hyperinflation guy, Catherine, but not now. Okay, there's things have got to change, and velocity. The thing that's scaring people into cash, it's got to scare them out, and we're not there yet. And that's how I'll call it, people waking up. But I would argue that those correlations haven't broken down, and and it's also something called Gibson's paradox, which is Larry Summers' big thing. But
Right.
they've got to let their thumbs off soon, and when those correlations resume, we're going to see a big move in gold very quickly. And I don't think that we're going to see any kind of I don't look for. I expect a low very soon.
Catherine, is China and Russia part of Mr. Global?
Mr. Global, during the 90s, Mr. Global raped Russia to try and get a hold of the oil assets. I think, one of my favorite books about what's going on right now is Jim Norman's The Oil Card, because I think a lot of what we're watching is sort of strategic manipulation of energy prices and access to energy. But I think Mr. Global raped Russia, got control of some big oil pieces, but got the Russians so hating Mr. Global that they've been pretty ornery ever since. And I think a huge amount of the money that was pulled out of the developed world was reinvested into China in the hopes of, asserting a position there. So when money comes in from China, the Chinese do something. My question is always, is that the Chinese or is that Mr. Global? But I absolutely agree with Ty that you have populations over there who understand the value and importance of gold and are buying major. One of to me, the most heartening things right now is seeing a much greater broad-based base being developed on the retail side as people take advantage of this drop to buy precious metals. So I think it's going to be long run very good for adoption of precious metals in a variety of ways, and very good for the bull market.
What I'm seeing is two camps that are appearing. One I often refer to as the currency cartel, where 90% of the world's trade is conducted in basically four currencies, whether the US dollar, the yen, the euro, or the pound. And these are the countries that are rapidly debasing, have the biggest debt in debasing the currencies. But if you can't go anywhere, when one currency goes down, one's got to go up. The only alternative there is no alternative. But we have China and Russia and the other BRIC countries who, on the flip of it, can't buy gold fast enough right now.
I beg to differ. And to me, when one currency goes down and another goes up, that's a very short-term relative thing. I believe the currencies are managed very tightly by Mr. Global, and that they are actually devaluating simultaneously, regardless of the ups and downs.
That's correct. Actually, Ty, you're absolutely right. That's why it's coordinated in a cartel.
Currencies don't float. They just sink at different
They're all sinking because the common basket here of the controlling 90%. And where it was going, so I absolutely fully agree with you, Ty, on that. But where I was going on this, Catherine, the United States is a world reserve currency. And we have $6 trillion US dollars that are out there around the world. And they've had to be there because of the trade, vis-a-vis the petrodollar relationship, vis-a-vis the amount of trade that is the United States used to conduct. But what is changing, that is changing, the United States isn't a dominant trading partner. And these agreements that are now being structured between China, Russia, etc., to trade in non-US dollars is now pushing a lot of, or rather reducing the need for those US dollars, which it's only a matter of time are going to have to go somewhere, and that's back to the United States, and that has the potential of writing high inflation rate. Are you seeing that?
Well, here's my question. In my experience, the value of the dollar is set by the military, not by fundamental economics.
Yes.
In other words, we're watching an economy. The reason we're struggling, if you're an Austrian economics or economist and you believe in Austrian economics, then you believe in creating fundamental economic value. That's not the model that we're watching globally. It's what James Turk called the central bank warfare model. And basically, the United States right now controls the satellite lanes and the sea lanes. And as long as they control those things, they control energy. And as long as they control energy, they control the planet. Now, one of my big questions is, are they trying, because of what's happening with technology, are they trying to flip from control of energy to control from the food supply? Because it's going to be the seed and food supply that ultimately probably is at the base of the supply chains if new technology comes out. But one way or the other right now, the U.S. controls. And what we're trying to understand is, are issues going to get solved by economic warfare? Are they going to get resolved by war? And, because we've gone from a world where physical force has been hidden behind covert warfare and economic warfare. And that's what's made the market so Orwellian. And I don't know the answer, but everything I say or everything I see says the United States continues to have strategic military control. And so the issue of sort of what happens with the dollar and where does it go, to me, is entirely a military question and not a financial one.
I agree. I agree with your observations there. But I would make a point that I think war is going to be fought, is being fought differently, and I'll get into the whole use of cyber war and how fragile our systems are and how disruptive they can be, and they immediately affect supply and across the globe, and that spills without saying into finance almost immediately, and how disruptive this can be. And that, in fact, is the military. I mean, the amount of money that the United States is now putting in and staffing for cyber war under the National Securities Agency is just amazing.
But the assault was started from outside the U.S., and now we're catching up. And I believe that, you talk about military. I actually believe that it's a combination of military and economic.
Yes.
And I completely agree that if you don't have the best army in the world, you can't have a reserve currency.
Right.
And
that's what J.P. Morgan said, isn't it? That's why I have the Navy.
The euro is, the only currency in the world that doesn't have an army behind it or a tax base. And I mean, it's the ultimate Keynesian construct. And that's, to me, one of the big epicenters of what's going on.
Yeah.
And, no, I would say that it's a more broad-based war, that some people are fighting consciously and other people are just kind of behind the curve and waking up. And I guess I'd put they're behind the curve and waking up in the United States, as to economic war. And that the Chinese have understood it for a long time. They've really got long-term plans. They manage the short term, but they've got their long-term objectives. And that the United States is really, in the mainstream, adrift for a long-term plan. And it's pretty much just winging it by the seat of their pants, especially out of Washington, D.C.
Well, I think, Ty, I agree with you as to the government. But if you look at what I call, my name for the sort of people who are part of the Anglo-American alliance behind the scenes, I call them the breakaway civilization. Because literally what you saw, if you go back to the National Security Act and all the different changes in law, what you saw between 1950 and 1980 was a group of private American corporations create a private government funding mechanism for them to control the most powerful technology in the world. And I think one of the reasons that the markets get so Orwellian is the group I call the breakaway civilization, who are, far beyond. They've now stolen enough money that if they just want to run a world government on dividends and interest, they can do it. And they've got the most powerful technology in the world, and it's outside the control of the U.S. government.
Thank God.
So, what?
I said, thank God.
Well,
although I don't. Be careful what I wish for, right?
Be careful what you wish for. So I think the question is, what are the strategic goals of the breakaway civilization? And more importantly, what is their technology? And I think that, to me, the most concerning thing is that we have a lot of excellent people, including Austrian economists, who can't fathom the kind of invisible weaponry these people have and can bring to bear. And I'll just tell you one story as an example. About 2 weeks before the Indonesian tsunami, I had a friend buy a closed-end bond fund that had 15% of its principal in Indonesian sovereign debt. He wanted some world bond funds and chose one. And then a week before the tsunami happened, it went down by 15% overnight with massive insider trading and absolutely no change in the market or interest rates that would signal, why that would be so. And when it dropped, I went to work with him trying to figure out what in the world had happened and why. And then a week later, the tsunami happened. And to this day, the only hypothesis I can come up with that explains what happened is they knew a week ahead of time.
Well, have you heard of HARP?
Oh, yeah.
I don't know if it's mythical or real, but...
oh, no, HARP is absolutely real.
It's been demonstrated. It's real. We're up against our hard line here, Catherine. I know you have another commitment. A final question for Catherine Ty?
Well, when can we have you back again?
You guys tell me I'd be delighted to participate. I think what we need more collaboration among all of us, trying to figure out what's going on. But the best source of information is to watch day to day what's happening in the money and to map out the money. And if enough smart people get together and do that, we can really start to get some pretty good maps of what's going on. So I'm delighted to participate.
That's the beauty of the web, both the dissemination of information and the ability to collaborate. And it's a powerful, powerful weapon.
And reach so many brilliant people. I mean, the depth of the people out there and the ease you can find and read them and absorb them is just, it's a gift to me. I pride myself on being a mental bodybuilder. And, I just, I get up at 4 a.m. and read until 7 or 8 and then look at the rest of the day. And it's my pleasure. But Catherine, I got to just say, it's just been wonderful talking with you.
Oh, it's been great talking with you guys. It's, I'm reminded of what the English poet says. He says, ye are many, they are few.
Catherine, could you tell our listeners how they could learn more about your work and your writings and so they could follow what you're saying?
I and the Solari Report team blog every day at solari.com, just solari.com, and we're publishing the Solari Report, and come on in and learn all about us. You can find everything there, lots of articles. My latest big article was something called Coming Clean Beyond the Fiscal Cliff, and it's a detailed look at all the reasons why re-engineering the federal budget is a much harder job than anybody could ever dream. And you can find it when you come into the blog at solari.com.
Well, thank you very much. There is just so many things for us to talk about. If you have the time, we're going to love to have you back in a future date. But all the best.
Okay. Thanks, guys. Have a great day.
You too.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.